Hi everybody, welcome to the complete MBA course. Today we will learn about the triple entry and some examples of it. So let's go. A triple entry is an accounting entry where at least 3 accounts are involved at the same time. That means that we're not using the typical 2 debit and credit, but we're adding a third one. We saw an example of that one in the last video, but this type of accounting needs more real-life examples, so I decided to add 3 more. Let's jump into them. The first one is the value-added tax. The value-added tax, or VAT, is a tax paid on some countries to final users. These countries don't consider companies as final users, so your company can claim back the whole VAT charge to the customer at the end of the fiscal year. This fact makes VAT transactions the most typical triple entry transactions in accounting. So before we go any further, you need to understand the 3 types of accounts used in the COA when talking about it. First, there is an account called VAT collected, or output. This is the money you have to pay to the government at the end of the fiscal year. So this is to government. The second important account is VAT deductible, or input. This is the money that governments pay you at the end of the fiscal year. So this is from government. And the third one is VAT to regularize. This is a temporary account used when the clients pay on account. This is the money is going, for example, to accounts receivable. So this is when accounts receivable or accounts payable. So as always, examples help a lot in the explanation, so let's do one. Imagine you're purchasing a 1,000 euro computer that has 20% VAT. How would you put that in the accounting books? So in order to help us, I'll drop here an accounting table, and I'll drop also the same charter of accounts that we used in the last video. So now, the first part in every accounting entry is to define the accounts involved in it. Firstly, you're using cash to pay for that computer. So we're using the famous 1.9 cash. I'll put that here, the 1.9 cash. That will be one of the accounts that we're using. Secondly, because you're purchasing a computer, which is a fixed asset, you can put it as property, plant, and equipment, or PP&E. That will be another of the accounts that we're using, 1.1 PP&E. And thirdly, the interesting part, because you're buying a computer from a retailer, you're paying VAT. However, as you learned before, this VAT will be recovered at the year's end using the VAT deductible, because the government will pay that back since you're not a final user. This account is a kind of accrued assets, which is here. You see here it says tax returns not paid yet. Well, this is a kind of tax return not paid yet. So that will be the 1.6 accrued, also called VAT deductible in this case. Good. So we have identified the accounts involved in our transaction. Now we need to know which ones are the debit ones. We're going to use the equation learned in the last video, and knowing where the accounts are, which are these, and these, we realize that both 1.1 and 1.6 seem to be increasing assets. Those are the debit ones. At the final part, we can put now, for example, property, plant, and equipment. Let's put that 1.1 property, plant and equipment, that is being increased. The second one being increased is 1.6 accrued VAT deductible, and the one being decreased is cash. So we put cash here. So at the final part, now we know that we're paying 1,000 euro in cash, and that one is not the debit, is the credit. So that 1,000 euro comes here, and that this 1,000 euro is going partially to VAT, the 20%, therefore 200 euro to VAT, and partially to PP&E, the 80%, so 800 euro. And there it goes. That's our first triple entry VAT transaction. You bought a computer for 1,000 euro, paying cash for it. A part of that you bought went to VAT deductible that you will get at the end of the year. It seems a little bit complicated, but once you've done that 2 or 3 times, you will become much quicker. I would say we can go to the next example. So let's go to it. And it would be discounts. In this second case, I wanted to present you a sales discount. So you surely have seen many times business offer discounts as promotion strategies, the so-called sales. The accounting entrance for them is also a triple entry type and is also very common. So let's check an example. Imagine you're selling merchandise for 96 euro and you put a discount on them of 6 euros. So at the end you're getting 90 euro for those trousers. Let's open our accounting book and see how it goes. So firstly, as always, let's identify the accounts involved in this transaction. The first account is of course cash, because you're getting cash from the sale of that merchandise. So let's note that here. We're getting cash. The second account is inventory, because inventory is decreasing. You're selling some stock from your inventory. And the third account would be marketing, because as a part of the earnings that should have gone into cash are being diverted into a promotion strategy. This is an obvious expense. So I'll look into expenses, which are here, and put, for example, 522 marketing for that. Good. So now we have identified the 3 accounts, which is inventory, cash, and marketing expenses. And let's check out which one is the debit. Using again the equation that we learned in the last video, we learn that there is an increase on one of those accounts that is considered as an asset and is the cash. That increase is 90 euro. So we can put that this is a debit. There is also an increase in an expense, and you see that increase and expenses are also debit, which is the marketing one. So 2 of those accounts are debit in this case, the increase of an asset and the increase of an expense. So both should come onto the debit side. Let's put them. 1.9 cash, and we said 5.2.2 expense marketing. The cash was increased by 90 euro and 6 euro went into marketing. Now for the inventory is easy. Our inventory value has decreased by 96. The sum of the cash and the marketing expenses. So now I should put here 1.7 inventory. And that's it. You just learn how to make an entry for a sales discount, a triple entry. Now let's go to a third and last example. This one a little bit more complicated. Accrued entries. So our third example today refers to accrued payments. If you saw the last video, an accrued payment refers to a payment in which the cash will be exchanged in the future, not now. Because of their nature, accountants need two different entries for these kind of payments. First is the entry where the payment is noted on the book. So you put an accounting entry where you have that note on the book. And the second is when the cash is received. Now you'll understand that with the example, but let's say, for example, you're selling a 1,000 service with a 20% VAT on it. And the client is asking for a payment on account. So as I explained you before, there will be two accounting entries. First, when the invoicing is done, and second, when the cash is exchanged. We'll check that later on. First, let's check what the accounting entry is when the invoicing is done. So in this first one, is very similar to our VAT example, so I will do that a bit quicker. There are three accounts involved here, so we'll first identify them, and I'll put the COA for that. So the first one is the accounts receivable, because they're paying in account. That one is being increased, so accounts receivable. The second one is VAT. If you remember from before in this video, now we're collecting money from the government, which means that this VAT is a liability with the government. It's going to be a 3.4. However, we don't have the money yet. So we will create a temporary account called VAT to regularize. So we'll create, for example, 3.1.1, which is VAT to regularize. The third account for that is a revenue account, the services one. That's the easy part. So now that we have identified the accounts, we have to find out which one is the debit one. Using our equation, the same as always, we will quickly realize that there is one asset being increased, the accounts receivable. That one is the debit. The other ones are the credit, and they should sum the same. So let's check how is it. First, the debit is 1.8, which is accounts receivable, and we're receiving 1,000 euro for this service. The other ones are 3.4 VAT to regularize, and 4.2 services. Remember that they have to sum the same, and we know that there is a 20% VAT, so the 20% is going to VAT to regularize and the rest is going to services. Well, that was the first part. This money is now on our accounts receivable. But later on this month, our client will finally pay us the cash. When that happens, we have to put a new entry. What we've done before now is this part, noting the accounts receivable. Now we have to move the money and get the cash. When the cash is received, we put the second entry. I'll prepare that here and now. Firstly, when we receive the cash, we have to move the cash from accounts receivable into cash. So we know that here there are going to be two different accounts involved, 1.9, which is the famous cash one, and accounts receivable, which is 1.8. So this one is very easy because everything that we have in accounts receivable should go into cash, because cash is the increasing asset. That should ring you a bell, and then that comes directly here, 1.9 cash, and that's debited for 1,000. What is credited here is the accounts receivable. So accounts receivable is credited for 1,000 euro. So what also is happening here? Well, the second part is the VAT. The VAT to regularize was a temporary account, as you remember. The final account where we know that the cash was exchanged is the VAT collected, as we learned before in this video, and we need to move the money into it. Which one is the debit? Well, you have to know that both are liabilities because both are in the 3.4 part of the COA. But if you check this equation, you realize that the one decreasing is the debit, meaning the VAT to regularize is the debit. I'll leave you that a little bit of time so you think about that. So I'm going to put that here as 3.4.1, which is VAT to regularize. It's the debit because it's a decrease in liability. So we will move the 200 euro here, and the 3.4.2 VAT collected is the one being credited. That is how it goes. That's your first triple entry transaction with accrual method. I hope it was painless. And that's it for today. Remember, if you have any questions, shoot them in the comment section below. And if you like these tutorials, thumbs up and subscribe. And if you're doing an MBA, check the links to my book, The MBA Guide, in the comment section. This is the first book with the complete theory and exercises needed to pass an MBA. So thank you all for watching and see you in the next video. Bye bye.